Buy now, pay later used to be for sneakers. Then it was for electronics. Now, people are using it for groceries. Not luxury, not travel, food. When a society starts putting its basic needs on installment plans, that's not convenience, that's pressure. And here's the thing most people don't realize. Buy now, pay later doesn't feel like debt. It doesn't look like debt. It doesn't sound like debt. There's no revolving balance staring at you, no 24% annual percentage rate flashing in bold red letters, just 4 small payments, spread out, easy. And that's exactly why it works. Over the past few years, these services have quietly moved from optional purchases to everyday survival. People aren't financing designer handbags, they're financing groceries, gas, DoorDash, basic household items. Because when rent goes up, when insurance goes up, when food prices creep higher month after month, your paycheck doesn't stretch the way it used to. So the gap gets filled, not by higher wages, not by savings, by installments. And that's where things start to change. Because buy now, pay later isn't just a payment method, it's a signal that millions of households are running thinner than they look. On the surface, spending still seems strong. Stores are busy, online carts are full, but underneath, payments are being sliced into pieces just to make them manageable. And when everyday life gets financed, the real story isn't about convenience, it's about how tight things have become. Today, we're going to break down what buy now, pay later really is, why it exploded so fast, how the system actually makes money, and why its rapid growth might be telling us something much bigger about the American consumer. Because this isn't just about shopping, it's about pressure.
What buy now, pay later really is. Before we talk about why it's growing, we need to understand what it actually is. Buy now, pay later, or BNPL, sounds new, but the concept isn't. At its core, it's simple. You buy something today, you split the cost into several smaller payments, usually 4, usually over 6 weeks. If you pay on time, no interest. That's the promise. And compared to a credit card, it feels lighter. There's no long-term revolving balance, no compounding interest building month after month, no minimum payment that keeps you stuck for years. It feels contained, clean, predictable. But here's what makes it different from older systems. This isn't layaway. With layaway, you paid first and received the item later. With BNPL, you receive the item immediately. The debt comes after. And unlike traditional loans, approval is almost instant. No long paperwork, minimal credit checks, sometimes none that impact your score at all. You click a button, it gets approved in seconds. And that speed changes behavior because friction matters. The harder it is to borrow, the more you think before doing it. The easier it is, the more normal it feels. And that's where BNPL becomes powerful. It's embedded directly into checkout pages, right next to the Pay Now button. Same font, same size, sometimes even highlighted. It doesn't look like borrowing. It looks like an option, another way to pay. And that subtle difference changes perception.
When people use a credit card, they know they're borrowing. When people use BNPL, many feel like they're just spacing things out, managing cash flow, smoothing expenses. And sometimes that's exactly what it is. If you have stable income, if you track your spending, if you pay every installment on time, it can function like a short-term budgeting tool. But here's the quiet reality. It is still debt. It's still an obligation against future income. It still reduces the flexibility of your next paycheck. And unlike a single credit card balance, BNPL doesn't sit in one visible number. It fragments. One payment here, another there, a third next week. Individually small, collectively heavier. And because each purchase feels manageable, the stacking doesn't feel dangerous at first. That's what makes it different. It doesn't overwhelm you with one big number. It surrounds you with smaller ones.
And when debt becomes small enough to feel harmless, it becomes easy to normalize. That's the foundation. Not greed, not recklessness, structure. The system was designed to feel light, and that feeling, more than the math, is what made Buy Now, Pay Later explode. So on the surface, Buy Now, Pay Later looks simple. 4 payments, 6 weeks, no interest. But if it's just a harmless budgeting tool, why has it grown this fast? Because this isn't small anymore. It's not niche. It's not experimental. It's everywhere. And the speed of that growth tells us something important.
Why it exploded so fast. In just a few years, Buy Now, Pay Later went from a checkout option for fashion brands to a mainstream payment system used by millions. Transaction volume has surged into the hundreds of billions globally. In the US alone, usage has grown several times over since the pandemic. But what matters more than total volume is who's using it. Younger consumers, especially Gen Z and millennials, adopted it the fastest. For many of them, this was their first form of credit. Not a credit card, not a personal loan, an installment plan built into a shopping cart. And that matters, because BNPL didn't ask them to apply for credit. It came to them, pre-installed at checkout, integrated into apps they were already using. Retailers loved it because it increased conversion rates. When you split a $200 purchase into 4 smaller payments, it feels cheaper. Average order values go up. Cart abandonment goes down. Merchants are willing to pay for that. BNPL typically charge retailers around 4 to 6% per transaction. That's significantly higher than traditional credit card processing fees. But retailers accept it because it drives sales. More approvals, more spending, more completed checkouts. And then came the pandemic. Stimulus checks, lockdown consumers, explosive e-commerce growth. Online shopping surged, and BNPL was perfectly positioned for it. It felt safer than credit cards. It felt modern. It felt controlled. But here's where the story shifts. As stimulus faded and inflation accelerated, usage didn't slow down. It increased because prices were rising. Food, rent, insurance, gas.
And at the same time, credit card interest rates climbed above 20% on average. For many households, revolving credit became more expensive, so BNPL started looking even more attractive. 0 interest if paid on time, small installments, short duration. But there's another number that doesn't get as much attention. A significant share of BNPL users report having multiple active loans at once. Loan stacking became common. One purchase split into 4 payments, then another, then another. Individually manageable, together complicated. And late payments aren't rare. A noticeable percentage of users have reported missing at least one installment, which means fees, which means additional strain. But here's the key insight. BNPL didn't explode because people suddenly became irresponsible. It exploded because it fit perfectly into the economic moment. Rising costs, stagnant real wage growth for many workers, higher credit card interest rates, lower savings cushions. When pressure builds, people look for flexibility. BNPL offered flexibility, or at least the appearance of it. And that's why its growth matters. Because rapid adoption during tight financial conditions often tells you more about the consumer than about the product. Buy Now, Pay Later didn't create the pressure, it responded to it. And the question now isn't just how big it has become. The question is what happens if the pressure keeps rising.
The stacking effect. The real risk of Buy Now, Pay Later isn't one purchase, it's the stacking. Because the structure makes it easy to say yes. 4 payments doesn't feel like debt, so you do it once, then again, then maybe a 3rd time a week later. Individually, each plan looks small. $40 split into 4, $120 split into 4, $75 split into 4. None of those numbers feel dangerous on their own,
But they don't exist on their own. They overlap, week after week, paycheck after paycheck. And this is where things start to blur. Unlike a credit card where you can see one growing balance, BNPL fragments the obligation. You don't see $600 owed. You see $22 due Friday, $35 due next Tuesday, $18 next week, $41 after that. The total exposure becomes harder to mentally track. And when obligations are harder to see, they're easier to underestimate. This is what researchers sometimes call payment decoupling. The purchase feels separate from the pain of paying, and the smaller each installment looks, the easier it is to normalize. But the data tells a more complicated story. A meaningful share of BNPL users carry multiple active loans at once, not 2, sometimes 3, 4, even more. And a noticeable percentage report missing at least one payment, not because they forgot, but because cash flow tightened. When rent hits, when utilities spike, when groceries cost more than expected, something has to give. And small, short-term loans don't disappear just because they're short-term. They still pull from the same paycheck. They still compete with the same bills. And here's where it connects to the bigger picture. Savings buffers have been shrinking for many households. Credit card balances have been rising. Auto loan delinquencies have been ticking up. In that environment, even minor disruptions matter. A reduced work schedule, a medical bill, a car repair. If you're already juggling multiple installment payments, your margin for error gets thinner. BNPL doesn't usually charge high interest, that's true, but late fees can stack. Accounts can get sent to collections. Some providers may restrict future access. And increasingly, missed payments are being reported to credit bureaus, which means something that felt invisible can suddenly become very visible. The danger isn't that buy now, pay later is inherently toxic. The danger is that it blends into the background. It becomes routine, normalized, just another button at checkout. And when borrowing becomes routine, fragility builds quietly. No alarms, no dramatic spikes, just a gradual tightening. And because each installment looks small, the overall pressure is easy to ignore, until it isn't. Because stacking doesn't break households overnight. It erodes flexibility, one payment at a time.
How the system actually makes money. At first glance, buy now, pay later sounds generous. Zero interest, quick approval, instant access. So how does the system make money? Because it does, and it makes a lot. The first revenue stream isn't from you, it's from the merchant. Retailers typically pay a fee on every buy now, pay later transaction, often higher than standard credit card processing fees. Why? Because buy now, pay later increases sales. When shoppers see smaller installments instead of a full price, conversion rates go up. Average order values rise. Fewer carts get abandoned. From the retailer's perspective, it's worth paying more if customers spend more. So buy now, pay later companies sit between the shopper and the store and take a percentage of every transaction. That's revenue stream number one. But that's not the whole picture, because not everyone pays on time. Late fees still exist. Missed payments still generate penalties. And while these fees are capped and often smaller than traditional credit card penalties, at scale they add up, especially when millions of transactions are happening every month. Then there's data. Buy now, pay later platforms collect detailed behavioral data. What you buy, when you buy, how often you split payments, whether you pay early, whether you delay. That data has value. It helps them refine approvals. It helps them target offers. It helps retailers market more effectively. But there's another layer most people never think about.
Funding. These companies don't just sit on their own cash. They often bundle large volumes of loans together and sell them to investors. Similar to other forms of consumer credit, The loans become assets, packaged, priced, traded. That means the system relies on volume. More transactions, more originations, more loans flowing through. Because growth attracts capital, and capital fuels more growth. But here's the tension. When revenue depends heavily on transaction volume, the incentive is expansion. More users, more purchases, more integrations, more everyday items financed. The model doesn't slow down when consumers get stretched, it scales. And that's important, because if consumers are increasingly using BNPL for essentials, then growth may not signal financial strength. It may signal financial strain. The system works best when payments flow smoothly, when default rates stay low, when consumers remain stable. But if household balance sheets thin out, even small disruptions can ripple outward. And because BNPL feels lighter than traditional debt, the expansion can happen quietly. No dramatic headlines, no immediate alarm, just more transactions, more installments, more fragmentation of future income. The companies win when consumers pay on time. They collect merchant fees, they maintain trust, they grow. They also collect fees when consumers don't, but the real dependency is scale. And scale requires participation, which brings us to the bigger question. If buy now, pay later is expanding into groceries, gas, and everyday life, what does that say about the condition of the consumer?
When financing becomes survival. There was a time when financing was about upgrades, a bigger TV, a new couch, a vacation. It was tied to lifestyle. Now, in many cases, it's tied to maintenance, groceries, utilities, everyday household supplies. Not because people suddenly want to optimize cash flow, but because monthly expenses have moved faster than many paychecks. Over the past few years, essential costs have climbed. Rent adjustments, insurance premiums, food prices rising steadily, energy costs fluctuating upward. Even small increases compound over time, an extra $80 here, another $120 there. It doesn't feel dramatic, but it accumulates. And when expenses outpace income, the gap has to be managed somehow. Traditionally, that gap might be absorbed by savings.
But savings buffers for many households are thinner than they were, so the adjustment happens elsewhere. Credit cards have absorbed part of it. Balances have risen. Interest rates on those balances are high, which makes revolving debt expensive to carry. So installment tools start to look appealing. Short-term, structured, no visible interest if paid on time. But when essential spending gets financed, the meaning changes, because financing discretionary spending is optional. Financing groceries isn't. It suggests cash flow timing isn't lining up with real life.
And timing matters. If your paycheck covers everything comfortably, you don't need to split your grocery bill into 4 payments. If it doesn't, installments become a bridge, and bridges are useful until you're building a new one every month. That's when flexibility starts shrinking, not collapsing overnight, just tightening, one installment at a time. And here's the subtle shift. When more households rely on structured payments for basics, aggregate spending can still look strong. Retail data can still show resilience. But underneath, the structure of that spending changes. It becomes pre-committed. Future income gets partially spoken for before it even arrives, which means next month has less room, less margin, less shock absorption. And this is where buy now, pay later stops being just a checkout feature. It becomes a barometer, a quiet indicator of how stretched households feel. Not broke, not bankrupt, just tighter, more dependent on timing, more sensitive to disruption. Because when survival expenses are being sliced into installments, the question isn't whether people are spending. The question is how they're managing to keep spending, and whether that management strategy is sustainable.
The signal beneath the surface. Buy now, pay later isn't the cause of financial pressure, it's a response to it. It didn't create higher rent, it didn't push up grocery prices, it didn't raise insurance premiums or utility bills. It adapted to an environment where those things were already rising. And that's why its growth matters. Because payment systems don't expand randomly, they expand where friction exists. When income growth comfortably exceeds living costs, consumers don't need to split essentials into 4 payments. Installments are used for upgrades, optional spending, lifestyle choices. But when income lags behind expenses, borrowing starts filling structural gaps, not to upgrade life, but to stabilize it. That's a different phase of the cycle. And you can see similar patterns elsewhere. Auto loans stretching to 84 months, credit card balances reaching record highs, more households carrying revolving debt month after month. Individually, each trend can be explained away. Longer car loans make vehicles more affordable. Credit cards offer rewards. BNPL offers flexibility. But collectively, they tell a story about timing. Future income is being pulled forward, not in dramatic amounts all at once, but in fragments, a little here, a little there, enough to keep things functioning. And functioning is not the same as healthy.
A consumer economy can look stable on the surface while becoming more leveraged underneath. Retail sales can hold steady, spending can appear resilient, but resilience funded by installment plans is different from resilience funded by surplus. Surplus absorbs shocks. Installments amplify them, because once future income is pre-allocated, there's less room to adjust. If your next paycheck already has groceries from 2 weeks ago, a retail purchase from last month, a streaming subscription, a car payment, credit card minimums, then flexibility narrows. And flexibility is what protects households during downturns. This is where the broader risk emerges. Not that BNPL alone will trigger a crisis, but that it becomes one layer in a thinner financial cushion. When multiple layers thin at the same time, auto delinquencies rising, credit card utilization increasing, savings rates falling, small disruptions can cascade faster. Because the margin isn't wide, it's optimized. And optimized systems work well until variability increases, until volatility rises, until income becomes less predictable. Buy now, pay later thrives in stable repayment environments, short duration, fast cycles, high volume. But if repayment rates deteriorate broadly, the model feels that pressure too. Loan performance affects funding costs affect expansion affects availability, and when easy credit tightens suddenly, consumers feel it immediately, not because they were reckless,
but because they adapted to what was available. That's the part that often gets misunderstood. This isn't about individuals making bad choices. It's about a system that normalizes small, structured borrowing as a way to manage rising living costs. And normalization is powerful. When something becomes routine, it stops feeling like risk. It becomes infrastructure, a background utility. Click, split, move on. But if essential consumption increasingly depends on that infrastructure, then stability depends on it too. And dependence reduces resilience. Again, this is not panic, it's not collapse, it's compression. Households operating closer to the edge of their monthly cash flow, more efficient, more optimized, less buffered. Buy now, pay later didn't create that compression, it revealed it. Because when everyday life gets financed in installments, you're not just looking at a payment method, you're looking at a pressure gauge. And right now, that gauge is telling us something. Not loud, not dramatic, but steady. Things are tighter than they appear. Buy now, pay later isn't the problem, it's the signal. If more everyday life is being financed in installments, that's worth paying attention to. What do you think? Is this flexibility or financial pressure? Let me know below. And if you want more breakdowns like this on consumer debt and the economy, consider subscribing. Thanks for watching.